or whatever that is, that's because only institutional investors were able to buy shares at the IPO price. Then, based on demand on the market, when the retail investors trying to buy, that immediately pushes that price up to a higher level. And then, if some of these institutional investors or people within the company that don't have a lot of
Oh, oh, we got somebody. Hey, so yeah, I've been growing for a long time. A lot of positivity. I want to, yeah, I want to pump SNDL. I want to pump SNDL as far as I can go. I don't give a shit. La, 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 la. Oh, let's get it. SNDL. Pump it up. Run up the fucking score. YouTube makes you look good. Yeah, you look so good. It's not like, oh, Mango, you look stupid. It was like the camera is stupid. Hey, I know YouTube. Yo, like I feel so.
Services. So if you ever hear the word GDP being thrown around, just think of that as the total value of the goods and services that a company provides. So if that's growing, typically that's a sign that we are in a bull market. That being said, here's a drawing of one. We've had a pretty wild bull market run here with just a quick blip here during the pandemic, but all of these highlighted areas are examples of bull markets that we saw. So we had one that started in the late 90s. We had one in the early 2000s after the housing market crashed. That was the longest of history. And then we had this quick black swan event here, and now we're back up to, again, kind of the same trajectory we were prior, which is pretty wild how quick the markets came back. Anyway, now let's talk about bear markets. A bear market is when share prices are falling, most investors are selling, or they're just out of the market entirely. Bearish investors make money from falling stock prices, similar to how a bear would.
Oh, hey, run up the fucking score on SNDL. it's so bad because I don't like to speak if nobody's watching me. If somebody's watching me, I'll speak. But it's so weird. I don't like to. Yeah. And listen, um, I know YouTube tampers with views and shit. You'll have like 8 views, five, six, seven. They'll bring it down to like two, three. You can have like 90. They'll bring it down to like 70, 60. And they call it bot behavior. It's just, a way of putting it. They don't believe, they don't want you to have that much views. They just say, oh, it's a bot. Yeah. Delicious. Oh,
Of the emotions of fear and greed playing out before your eyes. Fear indicates that a bear market may happen soon, or it may not at all, but that's just a time when people are fearful of the valuations of stocks and they would rather have cash than have money in stocks. They would feel safer in cash, which is certainty. A sell off can often turn expectations into a reality. So that's kind of a weird thing to wrap your head around, but oftentimes the mere thought of a market crash, if enough people are worried about it, could actually trigger one based on people actually deciding to sell their shares and unload. Just if enough people are fearful and do that, that can often be the outcome and the reality. So here's some truth here about the stock market that I want to hit you with that you may not be ready for, but as a beginner, I want to
oh.
give you an understanding of these things so that way you have realistic expectations with what the stock market can and can't likely do for you. So most beginners often expect unrealistic returns from the stock market, period. They want to make 15, 20, 25% returns year after year. They want to be a day trader or a swing trader. This is how most people, including myself, enter the market. And most people are just not successful with strategies like that. And if you're expecting consistent 15, 20, 25% returns for many years going forward, that's just not really a realistic goal to have with the stock market. But as a result, because people are looking for outsized or unrealistic returns, many make the mistake of speculating, such as betting on a penny stock, looking for like a 100% return in the short term. So, one of my favorite quotes here is from Warren Buffett. It says, "The stock market is a device for transferring money from the impatient to the patient." So, what he's saying there, in my opinion, is that the stock market is a
I want
long
to see,
term
like,
game
what do you
here,
want to see?
and those who make short
Like,
term
let's go for
trades
two. Like,
are simply transferring money to those
what do you
patient
want?
long term investors. Also, guys, investing is 100% a marathon, not a sprint. So don't
Mm-hmm.
treat it
Super,
like a
super.
sprint. Short term investing and speculating is largely relying on luck, which is not a sustainable or repeatable strategy. And also, based
Speaking of
on the
facts,
emotions of fear and greed, most investors out there buy and sell at exactly the wrong time based on these emotional triggers. So now I want to cover something called market cap or market capitalization. This is simply the total value of a publicly traded company based on the price per share. So the best way to explain this is to simply understand where the formula for market cap comes from. And you simply take outstanding shares, or the total number of shares out there, multiplied by a set price per share, which is whatever the current market quote is for that share. That's going to give you the current instantaneous market cap or value of that company. So market cap is used to determine the overall size of a company based on that perceived market value, which is set by the overall feelings of emotion and of fear and greed that these individuals who own shares actually have. Those emotions play out every single day, prices fluctuate, and so all throughout the day, the market cap of these publicly traded companies fluctuates too. So even though the business of Apple might not change on a given day, it's entirely possible to see the value of that company fluctuate billions of dollars with nothing actually happening, just based on investor sentiment surrounding that stock and the overall market. So that being said, stocks are broken up into 5 main categories based on market capitalization. And I have a couple of examples here just so you guys can reference what these companies are. So first of all, you have Microcap, which is companies worth under $300 million. One example here being Sally Beauty. Small cap companies have a value of $300 million to $3 billion. For example, we have AMC, popular stock people have been looking at with these Reddit users, discussing these stocks and all the frenzy surrounding them. A mid-cap stock ranges from 3 to 15 billion. Penn National Gaming is an example of this. Large cap ranges from anywhere from 15 to like 100 billion. That would be a company like Twitter. And mega cap is like $100 billion plus. That's like Alphabet, which is the parent company of Google. Now, there are no set rules on what is considered micro, small, mid, etc., but this is just a generally accepted guideline that I was taught and that I found myself. But some people may disagree and say, oh, under 5 billion is small cap, and there's no reason to split hairs. Just understand that smaller companies are usually worth a couple $100 million or a few billion versus something like Google, which is multi-100 billion, if not $1 trillion company at this point in time. So typically that's a good way of, when you're looking at a stock, understand that you're looking at a micro cap, small cap, large cap. What type of valuation are we looking at on this company in terms of what does everyone think the company is worth? And later on, we're going to talk about how to tell if a company is overvalued or undervalued. It has very little, if anything, to do with the market capitalization. So don't right off the bat just think that Alphabet is way more expensive than Twitter. It may just be a larger company that commands a higher valuation. So now let's cover some of the characteristics of stocks that fall in these categories, okay? Microcap is typically the smallest and riskiest stocks on the market that are going to have the most fluctuations. Small cap companies tend to have a little bit less of that movement, still a lot, but often have huge growth potential, but there's still a ton of risk there because they're smaller, less proven companies. Mid-cap stocks, you often get a blend of safety of the larger companies, as well as some of the growth potential of small companies. So mid-cap is an area I actually like quite a bit in terms of looking for some growth and some stability. And then large cap stocks, lower risk stocks for those looking for appreciation and dividends. Almost all of my money is in large cap blue chip dividend payers. I'll explain what that means later. But for one of my thoughts here, guys, in my opinion, most investors should avoid micro cap stocks, maybe even small caps, and be cautious, understanding there's a much higher degree of risk involved, and you're just more likely to see those drastic price fluctuations, which, as a beginner, that's kind of the opposite of what you want to see when you get started. Next up here, let's cover the PE, or price to earnings ratio. Well, the PE ratio measures the current market price per share relative to the earnings per share that a company has. The best way I like to explain it is how much you are paying for $1 of exposure to company earnings. So, for example, if a company had a PE of 30, that means that you're paying a value of $30 for $1 of that company's earnings potential. And so that PE ratio is a good metric for understanding if a company is over or undervalued based on the market and based on competitors. Easy calculation here, you take the market value per share divided by earnings per share, and that's going to give you the price to earnings ratio. The PE ratio is a comparison tool. It is not a one size fits all thing where you just have to check this and it's going to tell you. There's a lot to valuing stocks. The PE ratio is a good tool to utilize among others. It's typically used to compare stocks within the same sector or area of business, and that's just based on levels that you see in sectors or industries. For example, utility stocks often trade at a lower PE, where tech stocks trade at a higher PE. So if you were comparing the PE of a tech stock to the PE of a utility stock, it's not going to be a very helpful comparison. But if you compared the PE ratio of two utility stocks, it's going to be a much more useful comparison tool. So a high PE
don't make me act a fool. I saw it on my mom.
is overvalued. Usually,
I saw it on my mom. Like this shit, like make me act a fool.
Can indicate the stock is undervalued, but like I said, it's not a one size.
What the hell am I gonna say? Nobody watching.
Because a company that is not generating earnings
Let's record a video.
No PE ratio.
I'm talking to myself.
PE, so it's not useful at all for looking at companies that don't have.
I know YouTube.
Are not profitable because it's just not.
They tamper with views.
Also, a company can have a low
because of bots.
But if earnings are also going down, that means that as the share price is going
bot
lower,
behavior.
that PE is actually staying the same. So that's
referred
to as
I'm gonna get money. Like welcome to my YouTube channel. This is Microcap.
Just understand that we recognize what the
I want to run up the score in SNDL. Like, what do you want?
But it's not a one-stop shop.
What do you want?
Low PE does not always and rarely doesn't mean that something is a screaming bot. So just to give you a few examples here of some companies and their corresponding PE ratios. Apple has a PE ratio of 36.49. Microsoft is 38.49. So if you compare those two,
I wanna run up the score.
A better deal right now than Microsoft, and I own both in my dividend portfolio. IBM, on the other hand, has a PE ratio of 19.39. Obviously, a company I also own myself too, but one that people are not nearly as excited about or involved in a different business, for the most part. Although IBM does a lot of cloud computing, that's what Microsoft and Apple do. So I have a lot of IBM in my portfolio, and I'm hoping that's one of these stocks that, over the next 5 or 10 years can get up there with the likes of Microsoft and Apple. And then Hewlett-Packard, I don't even know what that company is doing anymore, but they're coming in at a PE of 13.73. So investing $36.49 in Apple stock will expose you to $1 of Apple earnings as of February 16, 2021, which is when we made this slide here. So that's the best way to.
How much?
And essentially what that means.
I can talk numbers, but it's just a small retail investment money.
For $1 of earnings.
You can see my video. You can see my YouTube videos in there.
So it's slightly cheaper.
Get into
so that's
little
kind of how I like
numbers.
to use the PE ratio is comparing stocks
How much
within the same sector or industry that are doing a similar
invested in this and how much I put in there.
Let's talk about volume. Volume is how many shares of a particular stock
found.
were traded that day. And then we also have another term called liquidity, which is the degree of ease associated with exchanging that asset for cash. So high volume stocks with
$300, you can get like 530 shares, or like 570 shares.
Stocks on the New York Stock Exchange
at its current price.
They have a high degree of liquidity because it's pretty easy to exchange your shares for cash, and you have a good idea what you're going to get back for it based on the quoted price. You will have, if there's low trading volume, you're going to have
some of these stocks, they just run off attention. They just run off attention. They run off people. They run off people that have more experience, that have more years. They got connections with the media. They have connections with networks.
So that's what I like to do is
They're probably, they probably know board members. They probably know the CEOs of the company or the company itself, and that's how they get it popping.
It's just an interesting indicator that tells you there's more people trading this stock today
Yeah,
than we typically see on an average trading day. So volume is just how many
but
shares
like, just being completely honest, I just want to pump the stock.
during the market hours.
I just want it to go up.
Also, we
I
cover
mean,
this later, but market hours.
I can get on here and be like,
basically 9:30 a.m. to 4 p.m. Eastern Standard.
speak about, because I've been to work also. That's pretty good. You just say like, oh, the current knows the latest news. The Wood 360 view like that.
Some brokers offer pre-market or
I just want the damn thing to go up.
most people exchange their shares during that 9:30
I want to make more
a.m.
money.
to 4
I want to make.
EST window. So just for example, here looking at a volume chart, we're looking at Penn National Gaming, and at the bottom, that chart is actually showing us trading.
I hate it when people leave.
You can see where
People leave. I've been gone for like a month and 2 weeks. I haven't posted because everything was boring. I don't know. I just wasn't working.
So we highlighted
I wasn't working on my channel, but
you can see where
damn, it kind of sucks to be going for that long. It hits you. It kind of, people.
However, it's not
It's fucking, but that's again like my fault, right?
When you see the
Because I
move
wasn't
in the
posting.
volume, the price
But
is already
yeah.
moved, and so there's not usually a great way to like jump in on the stock.
But really, if you look at, AMC is a movie theater chain, GMA is games, and and gaming consoles and stuff.
So now we'll talk about my
You got CDC, you got ACB, you got Tilray.
I am a dividend investor myself.
I think ACB is a Canadian company.
Portfolio is dividend
Torre
stocks,
is a
so let's
Canadian,
cover what that is here.
United
And
Kingdom,
I'm not gonna
English
go into
company,
a lot of
but
detail here because I actually
the
have a
UK.
full 52-minute step-by-step
CDC,
video
I think, is
about
Canadian
dividend
also. I
investment.
think
I'm gonna put
CDC.
a card up in the
And
corner,
there's a whole bunch
so
of
we're
other
gonna
names
breeze through it
also.
here and cover a lot of important details. But if you want more information,
I can get to it. I can get to that. But like,
as a supplement for this, after you go through the whole thing here. So
because that's just my way of thinking. I traded Torre. I think I sold that too. Like, I brought it last year in October and November, around the same time SNDL took off to $1. And I think Tilray was trading like at like $6 and some change. And Tilray went up to $77 about 4 months later, February this year. So
there's not usually as much risk associated with these stocks as there is with some of these smaller growth stocks. So
yeah, you can follow the discussion on Reddit.
Worry about the stocks I own. I own, Titans of America and the world.
And I think about other stocks, which I don't want to say the name, but like a stock like TCAP, which is an NFT stock, which it just took off, like literally just off attention and just off of the cryptocurrency market and digitalized currency and NFTs and digital art and stuff like that. It just took off. People just bought it like crazy. If you let me look at TCAP.
So those dividends are often reinvested into buying more shares.
The TCAP is pretty low. $4.04 right now.
Because they can kind of hedge against the loss. So let's say, for example, you bought shares of a company with a 5% dividend.
The TCAP went up to $74.
Maybe that share price went down.
At its lowest at $1.22. So I like to look at things in these ways sometimes. That's just how my mind works. I like to correlate it like that. It probably does help because I am in it for the long term. So look at it like that. I had a nice little game. You can see my nice little game on this video. That was really fun. But I don't have the luxury to be like, I'm not seeing on how the cash like, come back down and shit. So it takes a lot of responsibility on your own part. A lot of responsibility on your own part, to responsibly sell when it is time to sell, and you will know. You should know when it's time to sell. You'll have a lot of people, saying different shit, different narratives. Like me, I have to like literally like look out for myself. Like literally.
But on top of that, while you own that stock, you also earn
But it's fun.
dividends.
I'll tell you, doing this is fun. It's not bad.
316 per share.
Especially like your due diligence and all that shit.
So the yield on that
It's not
stock is
bad at
actually
all.
2.5%, which is pretty attractive. That's why I own Procter & Gamble. So let's say for this 1 year period, you owned 500 shares of Procter & Gamble. Well, you would have earned $7,620 of appreciation from buying low and selling high. But since that company also paid dividends, you earned another 1580 in dividends. So you would have made a total of $200. This is why I like stocks that can pay me in two different ways. That's why I
Oh,
love dividend stocks. So now let's cover a bit about risk and reward, which is probably not something that you want to talk about, but it's one of the most important foundational pieces of investing.
you
Because
know
every
which
investor out there has a
industry
different
leaves
level
money?
of risk
Like
tolerance.
mobile
And
gaming
risk
apps. So that
tolerance is
makes you can make
essentially
money
how
off
you
mobile
react
gaming.
to losing
Wow.
money.
If you
And
know how to
you should just
code,
start thinking about that in
I'm
your
reading a
own life.
book.
Like, how do
I
you
have a
react
book that I
when
just
you
read.
go to the
If
casino
you
with
want to see it, let me
$100
show
and
it to
you
you.
leave with nothing? Do you care? Do you get emotional? Do you cry?
Yeah.
Like that same
I'm
emotion that
halfway
you
done with it
feel
though.
at the
Look.
casino, if you lose money, it's going to be a similar feeling if you lose money in
So yeah.
stocks.
Right
Some
now
people are great with risk
I'm
and they
doing
lose
a
money. Other
what do you
people
call
are
it?
very conservative, and the thought of losing money stresses
A
them
web
out
page
more.
duplicate.
And so it's important to be honest
You
with
can see
yourself
like all the stuff,
when determining
that I
this risk
do.
tolerance. And age plays
I'm
a
not
large
like
factor
and like
in the investor's risk
well that's
tolerance.
what I do. I don't do
Type of
tutorials.
person
That's
would
just
have a
that's
very
what I do.
aggressive
So yeah.
risk
So
tolerance if they
I'm
want to
reading
make it
that
to
book
retirement. So if they
and
make bad
yeah.
financial decisions when they're younger,
A lot
they
of a
still
lot
have
of a broad
long
range
decades
of
ahead to
ideas. That's me.
undo those decisions and
A lot of
hopefully
ideas.
make money from other investments. Whereas a person
That
5
book.
years from retirement
Um.
would have a very
Oh
low
yeah,
risk
like
tolerance
you can go
built
to the Play
towards
Store and
their
you can see how
investing
many of these
strategies.
games, how many downloads
This
they have. They have
person needs somebody in the next
5
5
million
years
downloads. They
who has
got
a
10
younger
million
person
downloads,
that's
50
going to
million,
get
200
retired
million,
in
500
40 or
million.
50 years. They can afford
It's a
to
lot of
invest
downloads, and
more
for
and
each
spend that
download,
money on
they
more
probably get
expensive
like a
things.
dollar a download. They
So
probably get like a
remember,
dollar a download.
don't confuse investing with your
So
desire to gamble. One of the great
that's
lessons from
I
Benjamin
like
Graham's The
that's what I'm
Intelligent
saying.
Investor.
That's
Remember,
the type of shit that I'm into,
percent
honestly.
loss
So
requires a 100% gain.
yeah.
Kind of a funny
So
statistic
but
here, but if
probably
you buy something and it
by
goes
the
down
end of
50%,
2022,
you need a
sometime
200% return
you're gonna
to
see
actually
something
start
big. You're gonna
investing
see
accordingly.
a well put together project by me.
Speculative or risky
I started
gambling.
off reading
So
this,
just to show you an example here of a high risk stock
So
that
yeah,
paid off, and to be clear, I'm not saying that Tesla is a gamble. At this price,
uh,
you got to make your own judgment on that. I would personally say it's a little bit insane, the valuation. But I don't own shares of Tesla, but to those who do, I like the company. I don't really have too much against them, but the price is the only thing to
I
me.
don't feel
So
better
I'm not
around this
saying this
time.
was
Like
a
this,
gamble. It might be now, but
mm,
this was a high risk, high return potential stock. And you can see over the last year, it's up an incredible
yeah.
375%. It went from
All
170 per
right,
share up to
all right,
$800, which is
all right.
unbelievable. However,
Who's
high risk
off of
can also
streaming?
be bad.
You know,
Here's a high risk stock that went bad. It's called Next
I
Cure.
might
I
even
don't
do it
even know what this
myself. Like
company was, to be honest with you, but in 1 year, it went down 70.4%. So you would need more than a 100% return at this point on this stock
I
just
might
to
even
get
start
back
streaming
where you
myself.
started. Almost looking like a 3x or return potentially just to get back to that, $50 per share. So high risk is fun
But
when it
yeah,
works in your favor. When it works against you, it's horrible. So
I don't play
just
PC. I play
understand that if you
Xbox
are
One
taking the
X.
risks, this will play
But
out
I'll
in
buy a PC
reality at some
sometime
point in time. It's
in the very
inevitable
near
that you're going to
future.
put a bunch of money in a stock and it's going to
A
drop like this.
PS5
It may just be a learning experience for you.
and a
Alrighty, guys.
Nintendo
So it's
Switch.
another day here. We got some new energy for this video.
OLED or the
Unfortunately,
Fortnite
I
edition.
did
That's
have
pretty
a
cool,
bit of
right?
an injury yesterday, so I'll be wearing a cast of some sort on my hand. Nothing cool. Didn't get into a fist fight or anything like that, guys. Just an injury to the hand. So just wanted to mention it, and so that's what's going on here. But everything is totally fine. The show must go on. That being said, guys, so let's jump right back into it by talking about a very important document called the earnings report, which is one of the biggest distinctions out there between a publicly traded company and a private company. Because